Hey guys, welcome to another 21st Capital show. Today is Wednesday, May 7th, and I'm with VizArt from Glassnode to discuss our Bitcoin analysis and understand Bitcoin through the lens of data. Thanks for joining us. We'll take it a little bit slow for a few more people to join. Today we had the FOMC meeting. Federal Reserve kept the rates unchanged, and they mentioned a few things about how they view the future. We can talk about that, and then we've also published our weekly newsletter, Bitcoin Intelligence Report, on Monday. We can take a look at that, and also we will look at some newer data points that have emerged since then that guides us for potentially what's coming in the next few days. Hi Z, how are you?
Doing good, doing good.
Awesome. Yeah, so we are we have a kind of a looks like an undecided market. It goes up, goes down, goes up, goes down, and it just can't break the 100K mark. Seems like the market is still trying to understand what to do and how would the tariffs finally affect the economy. So today we want to be a little bit shorter than usual, to be just maybe a few minutes shorter, to be more concise. Maybe I'll begin talking about the macro side of things and what happened in today's FOMC. Just give a brief and some forward look and take a look at our report. Then we can get an update of on-chain data from UZ. How does that sound?
Oh, great. Let's do it.
All right. So if I bring my... Yes. So here, this is the report we published 2 days ago. It was about the observation that a lot of profits have accumulated in the network, and this can sometimes mean people begin realizing the profits, putting downward pressure on the price, but doesn't have to be. So our question was, there is resistance here. Whether are we able to break above that resistance or not? Since that time, in the last few days, we have tried a few times to pump and then come back down. We're kind of stuck. So, but let's look at the macro side of things first, which is the foundational force behind Bitcoin's moves. Basically, what we got in the data in last week and a few weeks before that was that we got GDP data, which are showing pretty good results. I mean, on the headline was negative, which could have been. Let me scroll down. The headline was negative, so this was the first negative reading since 2022. So this might feel worrisome as it could show a recession path at least. But actually under the surface, when you look at it, excuse me, it's highly influenced by the large amount of imports. Why do we have a lot of imports? Because people and companies were trying to front run tariffs. So everyone knows products are going to be more expensive, and then they basically try to buy ahead of time. We have pharmaceutical companies on record saying that they have, some of them imported like a full year's worth of supply before tariffs actually go into effect. So all the GDP data for Q1 that we got is covering all the front run. None of it, which was the April effect, none of it actually is represented in the GDP data that we have. But nevertheless, this huge amount of import is negatively impacting GDP calculation. And then we have reduction in government spending, this red thing on the negative side, compared to last quarter and also last year. We see typically in the Biden economy, government was a positive contributor to the GDP. In Trump government, in Trump administration, it's not. It's negative, probably reflecting all that Doge cuts and relevant, program cancellations and all of that. So government is trying to spend less money. Then we have this orange, which is personal consumption. So consumers have significantly reduced spending since last quarter. People are a little bit afraid, perhaps, but actually, when you look at it compared to the same time last year, it's pretty comparable. Maybe a slight decline, a very small decline, which is not a huge amount, but you see a slight amount of concern with consumers. Then the green one is private inventories. Inventories shot way up compared to last quarter, which was actually contributing negatively. It's way up. This is the mirror effect of imports. So when you import a lot, your inventories also go up. So that sounds like a lot of economic activity, but it's not real economic activity. Essentially, it's a pull forward effect. So in this report, and then finally, the blue section, which is fixed investment, this is what we really want to be high. And compared to last year, it's a little bit actually higher, but not significantly higher. So basically, we have a GDP report that's pretty much the same as last year, same time, with a little bit of reduction on important things, like a little bit less consumer spending, a little bit more fixed income, and government contribution negative. So in this report, we made the case that you actually have to remove inventory and net exports, and then you get a 2.3% for GDP without those items, which is positive, of course, and it shows the economy is still growing. Now, today at the FOMC, Chair Powell was also excluded the government spending. That's a new metric they're trying to use. And then in that, if you exclude the negative effect of government, you get positive 3%. So essentially the core GDP, if that's the right way to say it, they're always inventing new sub-metrics of the original metrics. But the core GDP would actually showed pretty strong growth. So when you have that, you're not getting rate cuts, and we didn't get any. Also, when you look at the labor market, we highlighted that the labor market is actually very strong. 177 jobs were created in April, and on average, 155 for the last 3 months. So, and it's pretty healthy. It's happening in all industries. A lot happening in transportation and warehousing. So this might be reversing next month, right? Because a lot of this import activity and inventory activity is leading to more hiring in transportation and warehousing. But so you can expect quite weaker job number moving forward. But nevertheless, other parts of the economy are actually doing very well. Unemployment rate is unchanged. We had additional participation in the economy. Average hourly earnings are up, but Powell today said they're not worried about this being a source of inflation because it's not going up too fast. Labor participation, as I said, has increased, which is good. More people are joining the job market from the sidelines, and again, unemployment has stayed steady for quite some time. All that is positive, but we do have two negative factors. One of them is essentially, let me mention that pretty much most of these things are backward looking, and the most forward-looking part of this data would be the claims data, initial unemployment claims, because if you're unemployed, you pretty quickly appear in unemployment benefits claims, but it will take some time for you to show up in the actual unemployment rate. But when you look at those more forward-looking numbers, initial claims have ticked up. This red brownish color shows it has ticked up, which is unusual for this time of year, but it's a very small increase. And you see the same thing when you look at continuing claims. These are people who claim they are unemployed and they still have not been able to find jobs, because you can claim you're unemployed and then sometime later you get a job and no problem, right? But continuing claims also spiking a little bit. If we do get another one of these, then I begin thinking about a trend might be forming. But this is a blip. Nevertheless, it's a very clear distancing or departure from the pattern. And the other thing we mentioned in this report is that this whole game, it depends on what happens with tariffs. We still don't have a clear sign of how these tariffs will impact the economy. Right? We are hearing a lot of bad information from the transportation industry, saying that a lot of ships are sailing empty, orders are down, orders are canceled, and China is in a lot of pain. That's another thing we were mentioning in the report. People on the ground, not traditional media, but people on the ground are saying workers are protesting, wages are not being paid on time, people are unhappy, factories are closing. So China is in deep pain, and they're just trying to save face. Similarly, when this is essentially an artifact of many American businesses canceling orders from Chinese factories and workshops. So what is the effect of these cancellations on the US? Those less than full ships are now on the ocean. They're sailing towards the port of LA and then East Coast ports. And pretty soon, in a few days, we should be seeing that not enough products are arriving. And then from there, you begin to see shortages at retailers. And this might end up causing upward pressure on prices, which is another reason Powell and company didn't cut rates. And this is all complicating a very heavy activity season, which is the inventory buildup that has to happen right now for Christmas, that is for holiday season, that is being disrupted now. So we are waiting. We have to wait maybe one more month at least to get a solid set of new data about how these tariffs are going to impact the U.S. economy. So far, pretty much nothing in the data. And today, Powell actually mentioned a few things. I'll give a quick recap of FOMC today. I took some notes, and then we'll have VizArt update us on the Bitcoin data. Let's see. Yeah, so a couple things that I really noted was that Powell basically said the risk to unemployment has gone up, but also risk to inflation has gone up. So they are paralyzed. Essentially, they can only say that there's more uncertainty, but they can't lean towards more or less cuts. And they understand, they perceive economic growth as very strong. They perceive inflation as slightly above their 2% level, and not down enough, but also also stable. And job market, again, like I said, we had mentioned all these in our report as well. We heard a lot of the discussions of the report today from the FOMC discussions too. A monthly job gain is great. 4.2% unemployment is stable. They're happy with it. Wage growth is not a significant source of inflation. And importantly, the way they think about tariffs is it can cause a one-time jump in prices, and that's not real inflation in the official definition. And Powell said, even if we do see some spike in inflation, we may be able to look through it, and our job is to just make sure it doesn't end up being a permanent process of inflation. So this is some kind of a hidden good news. That means, and we also heard this from Governor Waller last time, and a couple more Fed board members. They understand that a one-time increase in prices doesn't really warrant a rate hike or something. So that's why rate hikes are off table. And they also mentioned that they observed that the sentiment data is terrible. Consumers are worried. Businesses are reporting that business conditions are horrible. But because nothing is seen in the data right now, he's not ready to do anything. The board is not ready to do anything. So by definition, they are now putting themselves in a position to be late, right? They will wait until some damage happens to the labor market or some clear sign of inflation, not even one reading or two readings. Perhaps if a new trend of inflation begins, they'll react. But if you've been following our works, we actually don't expect a resurgence of inflation, because if tariffs really damage the economy in the way that it causes inflation, it will also quickly cause early recession, which will cause consumers to take a step back and don't spend. And when that happens, you typically don't get inflation. Instead, you get more unemployment. So that's the larger risk. And the market is also rightly pricing in 3 cuts this year. It was earlier they were expecting more rate cuts, 4. In the recent weeks, they have tempered the expectations to 3 cuts. I guess the lesson from all of this is the market is still in an undecided place. It's kind of a 50-50 between the Fed 2 mandates for inflation and unemployment, at least from the way they view it. And the Fed is saying we are not going to do anything until we see clear data, which is going to be late. So I think to be able to be ahead of the curve, we'd have to be following closely what happens to the labor market and see if companies do truly take a step back, and if consumers do truly take a step back. So spending data would be very important. If those things happen, then you get the Fed moving faster, but not at this time. And the market, I think, was largely expecting that. That's why we are getting a wash, right? I think we had a little pump and a little dump. Really, nothing's happening. So that's a wrap up of the FOMC. I think we also did a pretty thorough job summarizing, essentially highlighting the important pieces of data that will be here about in the FOMC meeting in our report. And pretty much that's it. The other thing I would mention is one piece that we also discussed is China is in huge trouble too. And that might bring them, I think they announced yesterday that they are willing to negotiate. And we do expect those negotiations to move forward. But it's not going to be fast enough for tariffs to be unimportant. So I think Trump administrations will keep some elevated level of tariffs for some time. And that will have effects on the economy. So that's a wrap. There is no huge support or huge negative effect that comes from the macro at this point. That's how I would characterize it. What do you think, Z?
Well, I cannot argue with the undecisiveness in macro, and the tail of this undecisiveness is actually very obvious, especially in the derivatives market for Bitcoin. But let's see what happens, because people are talking about the 3D, 4D chess is being played by new administration. More I read the news, the titles and everything, I think the only strategy is no strategy, and it's just so scary. And I don't know how the system was already under pressure because of the people were expecting debt ceiling is going to be, I mean, increasing. The currency was already expected to devalue, but a system that is already under pressure, going through all this uncertainty, I don't know what is the end game, and I don't know how long the system is going to just survive this uncertainty, undecisiveness, because there is a risk that this time it breaks down, that no one can repair it, and it's risky. And let's see what happens. And unfortunately, Bitcoin is pretty correlated with macro. I mean, this is what we were expecting to not happen, especially in long term. Let's see what happens. I'm very, very undecisive, and I'm like everyone following us could read the room. I'm pretty still bearish, because I want to see a long time of bottom formation. So it's more than a hope or expectation, not a future telling or promising people we're going to see a price lower than what we see now. But based on what I see, looks like a constructive bottom formation would be the best scenario.
Yeah. And if people have been following us, we did expect a rapid bounce back. Let me see if I can share that one. Yeah, so this is from a couple reports back. By the way, someone's asking how can we access these? Just go on to 21stcapital.com/BI. So we had this framework that mentioned we are going to get some negative effects from tariffs, psychological inflation worry, and then slowly disinflation. A lot of these are actually happening, and Doge is actually being proved to be not super effective. But this bounce back, I think what I was looking for was supposed to happen a little bit later. So it's actually, so while a lot of people were really bearish at this point, the bounce back happened much faster than even I would have expected. So that's why I'm a little bit still worried. I can't trust it yet. It's happened too fast for my taste, right? Exactly, kind of like what you're saying. We needed a bottom formation process to happen. Doesn't mean we will have a crash, but I still would keep some level of caution. I'm certainly not FOMOing in at this point, but this doesn't change the fact that you would have done fantastic if you were accumulating in those bottoms, right? So, but nevertheless, we are just waiting for the negative effects of these tariffs to pass. Like once that happens, everything else after that is positive in my book. There is going to be a lot of great news from tax cuts. The TCJA looking great in Congress. And once that passes, we will have permanent and perhaps a little bit marginally more tax cuts that helps the markets, whether or not you agree with the policy. They will be good for the market and Bitcoin. And there's also a lot of worried, scared money on the sidelines that have left the United States to gold, to international stocks, and other currencies. Those might, on the margin, at least some of it will come back as soon as we get rid of this tariff fight with the world. And also to the extent that they do deregulation, especially for banks, then we will also get a lot of support from banks extending more loans and expanding the money supply and all that. So Trump administration is this interesting combination where you get a lot of negatives up front. And this, I can guarantee you, this is part of their plan, because they know if they do the bad things first and then the good things, it's going to look great. But if they do the great things first and then right at the end they come up with negative things, that's what everyone remembers. So they're trying to do the most damage, I think, the worst parts first, and then from that point on come back with all the positive news. But doesn't mean they get what they want. But so far, I think the market has kind of traced back a lot of the losses. And I wouldn't be surprised if we also, stay here for some time or do a little bit of chop for some time before we can finally get out of this range.
Yep.
All right. So let's get to your discussion. You have given us quite a bit of detailed look in the recent report about the market from the on-chain data perspective. So today we are getting an update on that and then some more data points.
Sure.
So let me see if I can remove ourselves. Some of our settings have changed here, and I have to find a nice quick way to maximize the screen on the fly. I think it works. Go ahead.
Okay, perfect.
And the larger you can make those pictures, the better.
Sure, I'll do my best. So I think if people have read the Bitcoin Intelligence, they will see this chart. But my point, the point I was trying to make is the spot market shows a really positive reaction to the recent price action. You could see there is a buy the dip, and then that buy the dip was followed by a market rally to 93, 96, which is positive. That means they're getting response from their investment, and that's going to be building confidence, and more investors are going to be followed if the price keep going up or just do not drop much. We're seeing the game was playing well on the spot side, but when you get to the derivatives, it looks like they're still undecisive. You don't see much bearishness, a little bit in perpetual, but option market and perpetual and futures market in general, there just seems not being really motivated by the recent price action to just jump in and buy and go aggressive on the long side. This is the whole story, but I try to break it down. First of all, I have to emphasize, like this metric we already talked about in the report is talking about the percent of coins in profit. Like for every 100 coins, how many of them are in profit? By profit, we mean the price is above their cost basis. When price reached to 97, this metric broke above 90%. That means when price was trading on 97, more than 90% of supply was in profit, which means a positive signal from market to the investors. That means, okay, this is the basic step to build a confidence for new investors. So we got that first part very well, and it sent a really nice signal. If I break it down a little bit further, you can see since early 2023, every time we had a rally, for example, we had a rally to 30,000, which was almost the midline of the market, meaning that price was where the active investors was, cost basis of active investors was. So from the dip after the FTX, we rallied to 30. We needed 3 to 4 months to build up the base, and then the second rally, we had it to the previous all-time high, almost 60 something to 70,000. But that rally was really fueled up by ETF launching, spot ETF in the US. Then we had a little bit sideways, which was almost 9 months, I guess. I don't remember, from March all the way to November. So that baseline was still taking some time to build the base. The bottom formation phase was a stretching. And if you remember, the rally that was started around the election time was I think it started in October, just 1 month before, around 1 month before the election. That means that bottom formation was happening. Then a trigger from macro side just motivated the investors to just buy the dip strongly. And after a couple of lower highs, then you see, okay, higher low, and then market was going up. But you could see when you zoom in during that bottom formation, every time price was going up, you could see people are buying and FOMOing, and then market crash. So by looking at this data, we're not saying, hey, if you see a buy the deep or short buy.
Wait a second. This is very interesting. I want to spend some more time. Tell us how the intensity of these lines show the change of investor behavior, right? So first of all, I noticed this is also another interesting pattern that you get a Bitcoin price action actually happens in a few weeks, and for the most amount of time it's boring and negative and bleeding, but then for 2 weeks it jumps up several times. This has happened so far, right? Second thing, after it jumps high, it starts bleeding, and in the first few crashes, maybe in April 2024, people are not buying the dip, they're actually buying the top, like they're FOMO. And the intensity of those colors are showing. But this changed over time. Like after 7 months of this chop, behavior changed. No?
Yeah. That is exactly a great presentation of it takes time to build confidence, because people buying here, they are buying because they were staying sidelined because they say, hey, this is it. When the price was going down, we're going to go down, and they stayed aside. And when price just try to bounce back and go higher, they jump in and start to buy. This is human behavior. We buy at the top and we sell at the bottom. But believe it or not, that cycle is getting repeated again. But after a couple of like wave of new investors buying the top, we then see, okay, the very last dip was bought strongly and we had the higher low. That is when you could see, okay, they bought the dip again. That means this is a very meaningful wave of investors in two dips in consecutive dips after 1 month of the time difference between each dip. So you see that buying pressure was continuous. It was not losing the confidence for first dip after the dip they had at October.
Yeah.
If we go and move fast forward to the December 2024 when we had high, like a new all-time high, if I zoom in, you could see after prices started to drop, we had to buy the dip all the way back to 900, 1000. We had like buy the dip. You see, it's getting warmer and warmer. Again, when we had the bounce back from 94, they were buying the top. And matter of fact, there was a strong density forming here around 97. That means there was a really strong buy pressure around 97. And after failing to break above 105 and coming back to 94, it got even denser. Look, it got even darker. That means this level had a very high conviction. And all the way from February 2025 till now, that line, that price range still is having a really dark color, meaning the density of supply that was purchased around here in February, January 2025 remained unchanged, or they didn't sell much. That means there is a very strong conviction around this price. And when we got to the low in March, in February, and in early April, because of the uncertainty, because of tariffs and all other macro stuff, we didn't really see buy the dip until we had a rally to 84 when there was some talk about potential
deals.
Potential deals, probably because Trump was saying 145% is not forever. So a mixed signal in the market plus a little bit of frustration over time gave the signal to the market, okay, it's time to buy. And that buying, as I'm going to show, plus the buy the behavior we saw from ETFs. Let me show the ETFs. So ETFs that had a sell-off, and again, around April 20th of April, mid-April, you see the strong buy pressure from ETFs. So when you put this one plus this heat map, you could see there was a buyback in mid-April. And when we get back to the 93, me, myself included, was talking about there is a potential, these people who bought all the way from December to February, around 93 to 96, they probably look for an opportunity to exit at break-even point. That is the case for every single all-time high when you go back. Let me zoom out, all the way to 10 years ago. It takes time to load. But if you look back at every single all-time high, after we dropped to a lower price, like here, for example, on the bounce back, we had a little bit buy pressure in the market. Like we had a couple of the bounce back here. If you zoom in, every single of them had a buy pressure close to the peaks. That means people were saying, hey, that was a momentary or short-term bear market. We are back. We saw that one again. And if you see those people who bought at the recent top, they start to sell. Why? Because they want to get out at a break-even point, because they're realizing, oh, the momentum is just being declining. It is a good opportunity to get out of the market. But so far, we are not seeing any. We saw a little bit sell-off by these people at small margin or a little bit close to zero profit margin. But still, we are seeing a strong buy again at 93 to 97. So that is telling us, the spot market at least is believing that was it. The crash to 874 was the bottom, and market is going to go break it above the previous all-time high. This is the way that the spot market is reading the sentiment. Are they correct? Are they always correct? No, that's not the case. Literally, I think if you go back and statistically count every time they bought the top, at least 50% is going to be the result. Like there's no model saying, hey, if the spot market start to buy, that means we're going to go up. No, it depends what's the weight of the buying pressure on the buy side, on the demand side, because we have the derivatives, we have now the TradFi, start to buy and sell through ETFs. So we have to look at the whole picture. But what we can say for sure, the spot market showed a very strong buy pressure. Like I said, ETFs, for example, you can see that, which is a proxy for TradFi and North American institutional buyers. We definitely had a buy pressure, and that pressure is very similar to what we had in October pre-election. The question is it going to be sustainable? Another sign we had was this is showing the cumulative volume delta between buyer and sellers. If I want to put it simple, it means the people who fill out the orders, the takers. We look at the difference between the volume they bought and the volume they sold. The positive number here means strong buy pressure from takers, the people who go to the market and fill the market orders from order book, and negative values means they are selling strongly. The orange is Binance, and the Coinbase is the North American market. Binance is most of the time negative, but when we are close to see a rally in the market, it gets close to zero. The reason Binance is negative is because there is a weird combination of trades going on. They're selling in the spot market, going long in the derivatives. So don't look at it as pure selling. There is another side into this story. But when you see a confluence between the sell side slowing down and the buy side in Coinbase start to getting some traction, you could see market is having a strong spot market. As you can see, we had a buy the dip in Coinbase, which represent the ETFs, the public companies in the stock market that they own Bitcoin, mostly the institutional buyers, and the Binance was cooling down. So the spot market showed a buy the dip, and now we are on a very, very midline. Now, we saw the buy the dip, we saw the FOMO. If we see a higher low, me personally see the momentum. I can imagine a momentum that we break above the previous all-time high. But if the perpetual market doesn't follow the spot market, because usually when we have a long-term or mid-term to long-term bull market, you could see the spot market buys the dip and then a couple of dips being bought, then the futures market follow the lead and they start to see some momentum, some positive sign in the perpetual and futures and option as well. So far, we saw the step one, buy the dip. We are almost seeing the higher low, but it's not formed yet. If we see another higher low, I don't know what price is going to be, especially breaking above this strong density, high density supply zone. Me personally see, okay, we saw 1, 2, 3 positive sign. The momentum is obviously encouraging new investors to join the game. Okay, we should expect another rally to break above the all-time high.
But a drop below 93 is probably not a good sign.
Definitely, because we saw a lot of recent buyers that right after they jump into the market, they're seeing they lost some money. We could see something like here. Oh, they bought and then market start to correct a little bit. Then you see a strong sell-off. So after a strong accumulation, if market disappoint the recent buyers, that is a very negative sign. And to be honest, the correlation between the stock market and Bitcoin makes me very worried about the uncertainties around the China, US. I mean, I call it financial war now. It's like a war because Trump put out, I mean, the administration was sending a signal this morning saying they're kind of signaling that China should come to the table. It's like a childish game, but maybe people are right. There's a 4D, 5D chess game going on, which is ridiculous to me, but I'm not really expert in the macro stuff. But like I said, the futures market is lagging, and that lagging time is getting longer and longer. If the futures market follow the spot market lead, we see another higher low, then I can see the chance, I mean, the high potential for breaking above the previous all-time high. And that is, you know what's that going to happen? That is strongly proving the point that the 4-year cycle is gone. That's already, from my perspective, is gone. The 4-year cycle is already irrelevant, but we cannot say for sure if we have another like bear market for 1 year, 2 year, because we saw an all-time high before the halving, and that 4-year mentality is already been proven wrong. We had another rally to 60 something after China ban last cycle, almost 2 all-time high in the same cycle. Right now, we have a all-time high around 108. If you go back to 108 or above on 108, that 4-year cycle is totally irrelevant. So let's see what happens. Just to give some hint about why I say the perpetual market and derivatives market in general are still cool down, as I always just go through this metric, which is a beautiful metric, is the 7-day moving average of funding rate across all famous perpetuals. But if I just filter out the top 3 one, OKX, Binance, Bybit, you could see the major one plus the mean value, which is the dark line. The 7-day average is negative. That means there's actually a little bit aggressive, it's small aggressive momentum on the sell side or shorting the market. But when you look at the open interest, they are not really significant. Yes, their bias is aggressively towards shorting, especially throughout the rally, but the OI is not jumping. They're not building too much position on the short side. If you look at the OI in BTC term, you could see the OI of futures perpetual market is slowly building up. So they are positioning themselves. They are betting that we are getting out of the range, but we have to see very strong comeback, like 400, 390,000 Bitcoin worth of open interest before we're saying, hey, the perpetual already chose their game and we are ready to get out of the range. But so far, we had a small bounce back from the low. We have around 320,000 worth of Bitcoin. That's the value of the open contracts in perpetual market. If we see this is going up and the funding rate start to build up its way back to 10, especially the 7-day moving average to 0.1%, this is another strong signal that's saying, hey, the spot market start to show some momentum, positive momentum. Now perpetual is following. Beside the perpetual, the other market I look at is the option market. I'm not really into the option market. I just use the macro top level indicators. For example, if you look at the OI, before we jumping up, after we saw the dip, you could see the OI option was spiking. That means they were starting to build some position, and that was a significant build up. But as soon as we break to 93, we had a big expiry, bit open interest for expiry. I think it was early May or late April. I don't know what was expired. We had a huge expiration, and when we look at the spread, which is the difference between the implied volatility and realized volatility, normalized relative, realized volatility, you could see it is turned negative. What is telling us? The implied volatility is really low now. What does that mean? That means the demand for betting on either side or building a position in option market is very low as well.
So which market is this?
It's the derivatives.
Deribit, okay.
Yeah. I like the deribit because the OI for the ETF options are growing really fast, and probably they're going to have more share in coming cycle. But the thing is about deribit is it's a 24/7. They're not limited to one market, like US market. They are internationally available to most of investors. So I look at it like a 27 version of the option market for Bitcoin. So I really like it, especially the metrics that are looking at the implied volatility, not the size of the market. I really love them. So as you can see, we are seeing a low demand. One could say, hey, look at the historical values. Usually the bottoms were confluenced with when there was no demand for option market. And that's a really valid argument. The thing is, the question is how long it takes to that low demand zone actually get done. I mean, because we just touched the low, but if you look back, it took 3 or 4 months or 2 months here, 1.5 month here, or back in 2023, early 2023, it took around 6 months to get out of that low demand zone for option market. But all of them are a function of how a spot market reacts to the macro. What we want to see is if that V recovery you showed up happens in coming month, there is a strong, I mean, almost close to 90 or 95% if we give an equal weight to all factors we discussed today. Let's say we discussed 10 factors. If we give them 10% weight to every single of them, right now, spot market, ETFs, momentum in the spot market, almost 50% of them sending a good signal. We see profitability going up. If I go back to one of the metrics that we discussed in Bitcoin Intelligence, which look at the realized profit, ratio, which is looking at how many Bitcoin was realized in profit, how many Bitcoin was realized in loss, and look at the ratio. The ratio is almost 13. That means we are, for every coin that been moving in loss, 13 coin are moving in profit. It's a strong sign that, hey, market is telling the investors, showing the signal investor, it is becoming profitable. So there is a chance if you jump in, you might get 20-30% profit in coming month. That's a very strong signal. So the spot side is really constructive, especially the buying pressure at 93. But like I said, perpetual, option market, all of them are lagging significantly. So if all of them send a positive signal, plus the uncertainty just go away, even if it's for short term, then we can bet. I mean, because we're trying to be a little bit directional in our newsletters, in our calls, it might hurt us. I mean, because some people might just come back and say, "Hey, you say it's bullish," but we try to solve some problem for audiences. And one of the problems I really like to say is be cautious, but say what I think about market. And I think this is the tone in your analysis too, Sina, and I like it. So what we're going to say, the end message is, if we saw the confluence that we are expecting, then we can bet on the upside with more certainty. But right now we are at, I call it midline. The spot market showed the positive signal, but we're lacking the derivatives positive momentum, and that makes me skeptical because the macro has not shown any sign of improvement other than, like you said, they're getting cornered, that they have no other option to inject liquidity. It's almost becoming inevitable. But are they going to wait so long that we see another dip, another big drop in the macro market? It's just a matter of question. It's a $1 million question.
Yeah. Well, thanks a lot. I appreciate that review. And it's interesting. We have so much confluence on a lack of confluence, because the Fed is like, we don't know absolutely. The only thing we know is there is more uncertainty. So we absolutely have no idea which direction we should take our mandates. Is inflation going to be more of a problem, or labor market? Should we inject more liquidity or less liquidity? They clearly mentioned that they're undecided. And when you look at Bitcoin as well, a lot of the signals are showing the midline, as you said, and there isn't clear power behind the move that can take us to super high levels. And it's just quiet. It's very quiet. I think everyone is in the wait and see mode. Also in the business world, in the microeconomics, you see a lot of businesses are like that. They've done the work. They've built up the inventories ahead of tariffs, but now they are just holding back and to see what happens. No one in their right mind would be investing heavily right now when you don't really know what's going to happen down the road. So a lot of people are just waiting, and that wait, I think, again, is going to, it won't go away in the next couple of weeks. We need to give it a little bit of time so that everyone gets more clarity about how much damage is being done. Is it a small damage, or is it going to be more complication? And then people will unleash the money. They will begin investing, money will begin circulating, and some of that money will be finding its way into Bitcoin. And once the Fed has more confidence about inflation not rising again, they will be able to confidently resume that rate cut. So, so I think today's message is there's a lot of undecidedness, but there is some optimism in the spot market. Right? How would you?
Yeah. No, that's a really nice way to wrap it up. What I'm gonna say now is not a analysis, is more a hope. A Bitcoin DCA, an investor that really likes DCA, always hoping the market crash. Like when you know what you're investing in, when you are like trying to lower your cost basis. For us, lower price is always good news. So there is a little bit bias in my analysis recently. I'm a little bit bearish because I hope price crash a little bit and give us some more opportunity to pile up, because the liquidity injection is inevitable. Like either they do it in summer or late fall, they have to do it. And Bitcoin is tick tock, baby. it's ready to absorb that. One of the very first sign for liquidity coming back is Bitcoin market. That's the beauty of the Bitcoin. I mean, it's in universal reaction to liquidity. That's how I see Bitcoin. And the buyers seems like they are impatient. They're buying at 97 like there is no tomorrow. It just gives me hope for long term, but short term is hard to tell.
Yeah, and also confirming that, I just want to quickly mention this. In a lot of valuation models, we also see a super neutral valuation, right? So if you're a long-term investor, to give it a more positive note, we are right at fair value. So it's a good place for a long-term holder, but we also don't have huge amount of positive or negative forces at this point. We just have to wait and see and follow data. And definitely, if you follow our reports, you will access the latest of our analyses. Again, that's the link you can find on the page, 21stcapital.com/bi. And if you stayed all this time with us, a quick announcement that we will also be launching a premium service where you'll get access to more content and more details if you subscribe. So tune in for that. I think our next report will have the form of having a free section and a premium section. So on this Monday, we might be launching that premium service. More charts coming to the platform, more video analyses, and deeper reports for the premium section. And of course, we will also keep the free components always there. With that, thanks a lot, Z. Appreciate your thoughts today, and thanks a lot to everyone who stayed with us. And we will see you next week.
See you, everyone. Thank you, Sina.